Thank you guys for coming. I think it's going to be a really fun session today. A lot's going on in stablecoins. I first want to introduce everyone for them because we've got a tight session, and then we can jump right into it. First, we've got Nick from Agora. Nick was in venture for a while and kind of led stablecoin investing at GC, now has started Agora stablecoin to let people, to bring, I guess, well, Nick, you'll describe it eventually, but to white label stablecoins, bring yield to stablecoin issuers. Greg, M0, a decentralized stablecoin issuance platform, and Lauren, who's a product lead for Ripple stablecoin product. I think we can get right into the latest story that's sort of been going around. That's this hyperchain narrative. How hyperchain did a sort of a democratic process for issuance of the USDH ticker. That's going to be an ecosystem-specific stablecoin. And Nick, you were really active in this. And so I was sort of hoping for your rundown to contextualize how ecosystem stablecoins are going to work and how you thought about that bidding process.
Yeah, so maybe a little bit of additional context. Hyperliquid is one of the largest decentralized perp exchanges on planet Earth. It's used by dozens of trading firms. They originally started on Arbitrum. They've now built their own ecosystem and sort of chain. And so they released their USDH ticker now 2 weeks ago for a governance proposal, right? And this was a little bit of a fun one. And so what they did is, it was just the ticker. There was sort of no like canonical authority or preferential treatment given to it. But a lot of, there's clearly advance notice to, internal parties. And so a lot of folks like us use it as a marketing exercise, right? Because what it really called attention to is the fact that there's $5.5 billion of USDC on Hyperliquid, but Circle keeps the entirety of that reserve interest. And so now they're trying to drive more alignment back to the community. One of the reasons that we started our company in the first place is to deliver a lot of this yield back to ecosystems or applications so that they have another source of revenue. And so, we threw our hat in the ring. Athena, Sky, a bunch of people just started to throw their hat in the ring for this ticker. Ultimately, the original proposer won, but I think a number of issuers are going to continue to try to play in that ecosystem.
So, when I'm an investor, I look at all these new ecosystems and think, how are they going to take advantage of all of the action happening with stablecoins? These new payment opportunities, new ways of using DeFi, and Hyperliquid's had a ton of activity, a ton of excitement around it, and so it makes sense that people are bidding to participate in it, either using it as a marketing opportunity or as a real way to grow usage. Greg, to you, you guys had a big announcement recently with MetaMask, where now you're going to help them issue their stablecoin. How do you weigh different opportunities? Do I go after the L1s? Do I go after the apps when you look at getting more distribution of M0?
Well, we're kind of all over the place with our pipeline. We don't really try to focus on any specific type of partner, whether it's an L1 or a wallet or a brand. I think it's more, we look at, does this brand have the capability to actually scale a stablecoin, or are they just doing it more as a vanity metric and they want to, or maybe steal $5 billion from Circle's balance sheet? I think there's a few different paths you can go down. There's we are going to build this from scratch, but we have the distribution to do it. We have a bunch of USDC as path 2, and we want to convert it over, and that's obviously everyone's dream because the distribution's built in. And then finally, there's we're exploring a stablecoin, but we don't really know what it means or why we want it. We just see Tether printing billions of dollars, and we'd like to do that too. So I think we try to focus on the first two, but the third will become increasingly important as bigger brands enter the market.
Okay, so what are the opportunities where distribution's sort of obvious and then helping new participants come into the stablecoin space?
Yeah, I think wallets are a big one. That's why we partnered with MetaMask. They have all these users, they're captive, they're holding huge balances of stablecoins, even if it's in a non-custodial fashion. And there's an opportunity there for them to offer an incentive for a user to hold their assets so that they can both earn more money.
Got it. And then Lauren's at Ripple. You guys have taken even sort of a third path, and I know you're pursuing an OCC charter now. How do you look at the biggest opportunities for Ripple stablecoin to get out into people's hands?
Yeah, so I think it's interesting because it's a little bit different than what we've talked about so far. I think that Ripple customers, being banks, hedge funds, these sort of more traditional finance players, they're really looking for a highly regulated form of on-chain cash. And so for Ripple, what's really important to us is, we have Genius compliance coming out in 2027. Everyone will have to prepare for that. It's been quite important to Ripple to make sure from day one we are the lowest counterparty risk as a stablecoin issuer in the crypto ecosystem. That's what it comes down to when a treasurer is looking for which stablecoin they want to use in their business flows. With our legacy sort of standing in the payments business, we leverage, we've been in the crypto space providing infrastructure to businesses for 10 years. And so while the Hyperliquid RFP process was very exciting, for Ripple, we are just a bit more focused on sort of your traditional players and more on that front.
Yeah. Okay, so now, one thing that comes up for us a lot is who are the stakeholders in stablecoin issuance. I think, Greg, we were talking backstage about what onshore or offshore issuance looks like. That's a great way to look at sort of the custody versus distribution piece of stablecoins. Could you break that down for everyone before we get into what's most important?
Yeah, and this is kind of the whole premise of M0. We said, let's break down this stack into its composite parts and just try to do the part that we're good at. So if you look at something like Circle or Tether, these are monolithic issuers. They have the reserving, they have the issuance, they have the licensing, they have the distribution. They do everything in-house. We are instead a very thin layer that sits in between distributors and issuers and tries to match them appropriately. So for instance, with the MetaMask dollar, they wanted an onshore presence, so we partnered with a US money transmitter bridge, and now they are, gearing to be Genius compliant by 2027, but it's not a necessity today. And I think there's also a debate about how big the regulatory moat should be, and if it's as beneficial as we think it's going to be. Like right now, it's very hot to talk about Genius compliance. There's a lot of trade-offs with Genius compliance. In the US, it's very strict of who plays what role. Offshore, you have more optionality to let different actors play different roles in the stack. So I think over time now, like we're in this fervor, like the legislation passed, everyone's trying to grab their regulatory mode. I mean, if you look at the Hyperliquid thing, it was like the race to be the most Genius compliant. It was hilarious, but even though it doesn't exist. Yeah, I mean, I think what you'll see over time is like people will start to really understand these trade-offs. They'll say, okay, if I want to be in the US and I want access to this market, I will need to be Genius compliant, and I'll make those trade-offs. But if I don't, maybe I'll run a parallel strategy where I have an offshore presence and an onshore presence, and it'll get a lot more nuanced is the short answer.
Yeah, I'd totally agree with that. I've been a big fan of M0 for a long time, honestly. I think it's a great opportunity for a lot of on-chain finance to get involved in the stablecoin space, and in like a closed economy with like one of your payments customers, it makes a lot of sense. And I think what will be, I mean, like I said before, that bet on do these regulations really make a difference? I think it's going to come down to like the customer base you're really after. And I will say in crypto, I'm really excited for how that customer base is expanding right now.
Okay, right. So that's a whole topic. Where are network effects where are they today? What drives network effects? And what's going to sort of be the future of adoption? Are there new places that you can grow network effects in stablecoins? Nick, we've talked about that, just the two of us. How do you see Agora finding those new opportunities so that you can grow sort of your network effects of your own as you build your business?
Yeah, so maybe for like a little bit of stablecoin history, right? Tether was the first large stablecoin. Where they really have a moat is with crypto trading. 90% of stablecoin activity today is still crypto trading. Yeah. There's very few traditional businesses that are actually using stablecoins today for many of the new use cases that we expect to take off over the next 20 to 30 years. I think one of the reasons that USDC and Circle were so successful is because they had a relationship with the monopoly exchange in the United States, and they were very early into DeFi as that was taking off, because through Coinbase, they had really good on and off ramps. And so we sort of think we're in like this third generation of stablecoin adoption, and we're spending a lot of time on the next 100x growth levers, right? So, the Ethereum game and like the BTC trading liquidity war on Binance, those were fought many years ago. Like we're not spending time on that. Where we're spending time is a lot of these institutions that are coming in that want a regulated institutional grade issuer, either to capture the yield or so that they have better on and off ramps. And so, maybe just some of those areas are cross-border payments, FX, institutional finance coming on chain, and then fintechs and neobanks in sort of the global south, but also just broadly outside of the United States that are using stablecoins because they're a better form factor for dollars and money movement. So that's where we're spending a lot of our time. It's very early days in those markets. Like we still talk to companies that are trying to figure out key management, right? But that's where we think if stablecoins are to eat the euro-dollar asset class, it's all going to be institutional or business-related financial services.
But I'd like to dive a little bit deeper into what specifically are the network effects in stablecoins.
Yeah.
When I first started studying stablecoins closely, I underrated how important it is to have liquidity.
Yeah.
What a network effect that is to have everyone already trading against one specific token. I think M0 solves this in a really interesting way by allowing there to be a wide number of sort of branded stablecoins, but one asset of note. How do you think about bringing that world to fruition and making sure M0 is the sort of default DeFi stablecoin?
Yeah, well, I mean, the part I'd actually point you to is that we deliver all of our liquidity in other stablecoins. So like we're not out there, doing fiat connections, trying to do bank transfers to redeem. We deliver in USDC on chain essentially, sometimes USDT. So I think and this is the hard part about being an infrastructure provider. You have to be nice to everybody because you might work with them. But I think there's an opportunity for, at the end of the day, most existing stablecoin firms to come together and partner in some way, because there's just so many different parts of the stack that are currently being done by Circle and Tether. They are going to be hopefully the losers of this all, but they'll even win because people are still using their asset as a delivery mechanism.
Right, that's a great. We use USDC and USDT frequently, right? Because talking about network effects and creating new networks, I sort of broke down the broader categories, but what it comes down to is utility, right? So where is this accepted, right? Today that's lending markets, exchanges can use it as futures collateral on Binance, liquidity, right? Broadly speaking, and then is this paired against things that people want to trade or use, right? And today that's governance tokens and crypto, but it could be JAAA or some other traditional equity product that comes on chain in the future, right? And so that's when I talk about institutional finance. It's those traditional assets coming on chain and pairing that against your stable coin, and that'll deliver more and more network effects within that sort of microcosm.
Just to add one thing there, you going back to the hyperliquid example, that's obviously the hot topic, but look at the breakdown. Yeah, there's $5 billion of USDC sitting there as a savings reserve asset, but the customer is still coming to hyperliquid with USDC. Right. So even if you do replace the back end, you still need to meet the customer where they are on the front end, which is in USDC or USDT.
Well, Lauren, we were talking over breakfast about what Ripple is going to do a little bit more vertically integrated of a stack, and you made some interesting points about how the app layer might actually want to dictate what the stablecoin is that they use. How are you looking at going to market in a little bit less of a composable way? Maybe that's putting words in your mouth, but curious for your perspective.
Yeah, I think that composability, you give away some control, right? And so for us, again, that counterparty risk is our North Star. And so we need to be able to deliver that. For me, yes, we go directly fiat to RLUSD. When you onboard to Ripple, that's really important. And past that, we've been 100% focused on utility in everything that you just went through, but you can take that much farther, and now you have this form of on-chain money that you can use in cross-border payments. Ripple's been in the payment space for a decade. You talked about how you have these new TradeFi entrants, and they're like, how do I manage my keys? Well, Ripple has a bank-grade custody platform that we bring along with us. And so I think utility starts to be a really interesting conversation when you're bringing together each of the different pieces to, not necessarily completely change someone's business model, but just make it much better. For example, imagine Target was on chain, and now Target pays all their suppliers in RLUSD, and so it's in real time, and those suppliers can off-ramp or trade it for some form of fiat or maybe their own home local stablecoin, and then their users come with their their RLUSD or park it in a Target vault, and now you don't have to take on debt to get the couch that you have 70% of the liquidity for. Target gets that yield for a course of 3 months, and because you held that money there and Target made the difference of the couch, now you have a couch. These kinds of the flexibility that it brings into the traditional finance world, both for institutions and the retailers that we see looking for that in DeFi today, it's going to change how we work with money in our day-to-day lives.
Well, that's been something I love to hammer for people who are in TradFi. We're talking about better money here with faster settlement, nearly free, nearly instant, and much more programmable. But there are still some pieces that are missing for this puzzle. People are still struggling with on and off ramping. They're struggling with to get comfortable for a lot of traditional finance institutions with the regulatory and compliance space. This is for anyone, but what are the tools that you want to see built to help all of the stablecoin issuers be able to serve their customers better?
Yeah, I'm pretty excited about the expansion of on-off ramps to your basic fintechs. I think Revolut's been a great story, and I think we'll see more and more of that. At the end of the day, I believe the problem with on and off ramps will be solved through capitalism. Right now, there's a bit of a monopoly on how much you can charge to get on chain.
What do you mean by that? There's only a few on-off ramps, and so they charge a high rate?
Yeah.
Okay.
Yeah, there's like a weird moment in time, right, where Circle had Circle API, which was the easy way to get from USDC to fiat. They deprecated that, for a variety of reasons. In comes Bridge, and BVNK. They're able to charge like 50 basis points. That's now basically gone down to zero, right? So to Lauren's point, I think I'm not going to be worried at all about on and off ramps 12 months from now.
Yeah.
It's going to be free.
Yeah.
And that's going to be really exciting.
Yeah.
Imagine all the people that, I don't have to, it doesn't take any money from me to come join this new cool protocol that I'm excited about. I think that's going to be a great needle mover. And then on top of that, I think that we talked a little bit about the corporate chains that are on the rise. I think it's been pretty interesting to see these businesses want that control over their validator set. And I kind of respect the thought process there of, Stripe's big value add that they bring to their customers is the stability, reliability. And so they want to control that validator set to make sure they continue to give that. But what's going to happen there is, much like bank ledgers today require the Fed to sit between them, those ledgers will require these public permissioned blockchains to do the same. And I think the XRP ledger is in a really good position for that. We've been building on it for 10 plus years. It's a highly performant, low cost blockchain.
Okay, yeah, so I think that the on and off ramp is going to be big. Do you think the corp chains are all going to come with their own on off ramps that are going to respect this same falling price?
Yeah, I think so. One thing that I'm really interested in is actually just like the abstraction of all these disparate pieces, right? So through really good providers like Fireblocks or Turnkey or Privy, now wallets are really easy to embed within your application, and so almost abstracting away the cryptoness. Yeah. Because what people just want is they want instant settlement, they want to be able to earn yield quickly, they want low transaction costs and composable liquidity, and unifying that in an application where you don't even necessarily know you're using crypto is the dream, right? And so we don't talk about this a lot, but a lot of what we're spending our time on is actually building applications as well for businesses, right? That unifies these experiences. So you can control more of the customer, so to speak. But that's the holy grail, right? Because if you go to any of these, these businesses and say, hey, you want to eliminate, pre-funding, right? Or now you don't have to send, basically you can earn yield instantly. Every corporate in the world, especially multinational, will say yes. Yeah. Right? You see Robinhood talk about this on their earnings calls, how they use stablecoins to move money between their entities. 10 years from now, everyone is going to be using stables if you're a multinational. I talk about this a lot. Our dream customer in 10 years is Pepsi's CFO, right? Because they have dozens of banks, they have thousands of suppliers, they probably have tens of millions of dollars sitting in different accounts around the world to pre-fund supplier payments or, payroll, and like you can eliminate a lot of this and automate a lot of it, right? It's going to take time, but like that's what I'm excited about is like actually like unifying all these sort of would have been traditionally disparate pieces because we're so early into like a unified stack where you can just go to that person and say, hey, I can do all this for you out of the box. Don't worry about it.
Yeah, I think people think a lot about capital efficiency, where stablecoins are not as capital efficient as other forms of dollars because they're one-to-one backed by treasuries. But on the other hand, as you're pointing out, we will slowly get much more money velocity because we'll be able to sort of move through the treasury stack much more quickly.
Yeah.
I'm curious, right now, USDC, USDT have a lot of market share. If you were to paint a picture of 5 years from now, not necessarily how many stablecoins people know they're using, but how many stablecoins are people actually using on a monthly basis? Is it 1 to 5? Is it 5 to 50? Or is it hundreds and people don't really care?
But where do you draw the line at what's a stable coin? What's an underlying asset? Like if it's backed by M, is it its own stable coin? I guess so, right? But I think you'll use a ton is my short answer. You'll have no idea you're using them. But like the common thread here that we're trying to get across, I think, is imagine your life in a world where your transactions are not intermediated by commercial banks.
Yeah.
So I think Tether and Circle's market share in stable coins will be a lot lower, but their share of the entire economy will be massive because like the real loser here are the commercial banks. They're the ones that have not innovated in 50 years. So.
Okay, so that's widespread belief. We'll all be touching thousands of stablecoins.
I don't know if we'll be talking about
Yeah.
thousands.
Yeah.
I think it'll be very geographic and industry specific to what you touch. I think there will probably be 10 to 15 very large issuers, and then it'll start to tail off fairly quickly from there, right? I think if we look 10 years into the future, maybe Tether is close to $1 trillion, or like someone like a Tether is close to $1 trillion, and then you have a bunch that are, 50 to 200 billion, and then sort of like trails off after that, right? And you won't necessarily need to know who it is, right? Today everyone knows USDC, USDT. Our goal, and I'm sure yours is as well, that they know RLUSD or AUSD. But I just think pragmatically that's not going to be true, right? If stables eat the world financial system and payment system, which I think we all agree on, I also believe that 90% of the people that interact with these systems will not know that they're using stablecoins, and they shouldn't care.
Yeah.
Right? When someone is sending a wire from B of A to like a different money app that they have, you don't actually know all the codes they're using behind the scenes to move that value, and you don't care. You just want money to go from one place to another quickly and cheaply, and that's what stablecoins offer and deliver 100x better than Swift or the existing payment system.
I think that's the right analogy. Like to reverse your question, how many commercial banks does your dollar touch every day? You don't know, but it's probably a lot.
Yeah.
And I will say I do agree there'll be 5, 10 we know the name of. I do disagree. I think it's very important for the users to know the name of the stablecoin they're touching. Again, it comes down to that counterparty risk. I think we'll see more and more so people attracted to the stablecoin that they trust. And so while I do agree, there will be flows where maybe a retail user doesn't necessarily know what they're touching. I think our institutional users definitely will.
Yeah. Well, I want to take the conversation full circle. We talked about how money will move faster, how it's likely that users will treat stablecoins as sort of fungible in some way. Maybe not, but maybe they will for many users. We haven't touched on the business model of issuers so much. Each of the three of you have a different strategy here. How do you guys expect to be able to monetize as an issuer so that you can grow your business and use those rewards to grow the usage of your stablecoin? Or will you monetize external to the issuance of the token?
Yeah, I could start. So what we've seen thus far is making reserve yield or a aggressive distribution plan, and it pays off in equity. Difficult to make a bet on either one of those as a newer entrant. RLUSD went live at the beginning of this year. But for Ripple, what we know for sure is the stablecoin is a huge value add in the large number of other products that we've been bringing to market the last few years. Ripple Custody, Ripple Payments, basic infrastructure that we'll be bringing to businesses and the stablecoin itself. I think that there will definitely be reserve yield to be had. Maybe there's mint burn fees, and I think it'll depend on every issuer. But the truth of it is, there's definitely money to be made.
Yeah, I mean, our position's always been issuers are commodities. The issuers in our network clip 25 bips. That's it. I mean, this is already in 2025, not 2030. And we think the money to be made is around the periphery and connecting the distributor to their customers and giving them a better experience there. But issuance and holding reserves and earning the entire T-bill yield, like that's already gone. I mean, Circle and Tether, that's why they're fighting like hell for the hyper-liquid stuff, because it can only last so long.
Yeah. Well, that's the end of our time together. I want to thank all of you for coming, and especially to the three of you for taking the time to have a conversation with us about the next generation of stablecoins. Hope you all learned something, and give them a round of applause.